Hi, my name's John Fischer. I'm the Director of Investments for Socium Advisors. When we think about the recent war with Iran, there's a lot of uncertainty and anxiety that comes with that. And a lot of that is based on what we don't know. How high will oil prices go? When will the war end? The challenges with those questions and why they're so anxiety-ridden is that we can't know the answers to those questions. Put another way, government officials on both sides of the war are uncertain as to when and how this will end, even as peace talks are ongoing and whether or not they stick. So if government officials don't know how this will end, how can investors? The key is to shift our focus from what we don't know to what we do know. And there actually is a lot we do know. First of all, we know that panic is not an investment strategy. We also know that we've been here before. Whether you look at the Venezuela events earlier this year, or you consider the Russia-Ukraine war of 2022, these types of geopolitical events have a lot of noise and a lot of anxiety for investors. But from an investment perspective, when you look at the returns of the market after these types of events versus returns over the long run, they rhyme or they look very similar. So it's one more reason from an investment standpoint, we don't want to give too much attention towards these events when we think about our long-term financial plan. Other things we know, our economy, US economy and global economies have never been less reliant on oil. Think about it from this perspective. The car you drive right now, how many miles per gallon does it get today? The chances are it gets a lot more miles per gallon than it did 5, 10, or 20 years ago. And by the way, you might be saying, my car gets as many miles as I want till its next charge because we have the blessing of electric cars. And this is an indication of the efficiency of the technology that requires us to use less oil when we do need it, and also other energy resources that, again, reduce our overall dependence on oil broadly. We also know since 2020, the U.S. has actually been a net exporter of oil, meaning the U.S. economy has a moat of sorts around it because we're not as reliant upon foreign oil for our economy to thrive. And finally, oftentimes, if you look at these historical events, oil price spikes are temporary in nature. And so we want to make sure that we're not making short-term moves based on our long-term financial plan for something that's not likely to be persistent. Now, there's no doubt the recent declines in the stock market don't feel good for anyone. But the thing that we need to remember is that these types of intra-year declines are normal. Since 1980, the average intra-year market decline is over 14%. And yet, stocks have been positive 3 out of every 4 years on average since 1980. So when we think about this issue with Iran and how high oil will go and when this will end, we have to focus on making sure we're asking the right questions. The right questions are, was my financial plan built to include understanding that there's going to be volatile market times like these? Spoiler alert, it likely was. And most importantly, does my financial plan still work? Because if your financial plan still works, you can take your attention from an investment perspective away from the news and all the media and the worry that comes with that, and focus on all the things in your life that bring fulfillment that are built around your financial plan and why you have a financial plan in the first place. And finally, remember, when we think about our financial plan, have the headlines of your life dictate changes to your financial plan, not the headlines of the news. When we think about the headlines in the first quarter of 2026, one could argue that there are enough headlines to last the entire year. We saw the surprise military intervention in Venezuela to start the year, followed by the threatened indictment of Fed Chair Powell, both of which the market basically overlooked. And then came the war with Iran, which, as we know, the market has not overlooked, and we've seen the market stumble as a result. Despite that stumble, it's important for investors to remember where we were a year ago, it was right after Liberation Day in April when stocks actually fell by 10% in 2 days. And yet, despite that 10% decline in 2 days, the stock market finished higher for the year, up more than 15% for last year. And that's such a great reminder to investors that when you see these worries, I call it the wall of worry. The market will always have to overcome a wall of worry. And that wall of worry is there every year. The names on the wall just change. But we know over time that history has shown us that the market climbs that wall of worry, finishing positive in roughly 3 out of every 4 years. I think an analogy this time of the year really helps resonate with what we're going through right now, which is the idea of a lot of families and individuals are going on or have just recently gone on spring break. When you think about going on spring break, you see people who pay higher prices for flights, higher prices for hotels, higher prices for experiences, and long lines. And yet people still go. Why? Well, the key is the reason why they still go is because the value of a vacation and getting away from home. And you think about the other fact that the value of spring break is making memories with your family that will last a lifetime, that you see all of these people, despite those higher prices, pay the price of admission to go on spring break because the benefits are worth that higher price. We see the same thing with investments. What's the price of admission for investing? The price of admission for investing is going through uncertain times with spikes in oil, uncertain times like wars, uncertain times like elections, like the midterms that are coming later this year, bear markets, recessions. All of these uncertainties are the price of admission for investing. So why should investors be willing to pay that price? Because over the long run, markets have returned 10% on average each year looking at stock returns. And that far exceeds the returns that are earned in cash or money market investments that are more conservative. This is the reason why clients should think about, from a spring break perspective, the price of admission for investing and why investors should think about paying that. Now, when we think about the rest of 2026, we remain constructive on the year. Another reason for that is market fundamentals. When we talk about market fundamentals, these are what drive stocks over time. We look at interest rates. They still remain relatively low despite an increase due to the issues with Iran. Corporate earnings growth. We're expecting companies to see double-digit earnings growth in 2026. The most recent Fed meeting had them raise the forecast for GDP growth in the US economy. Why is that important? Because the consumer makes up 2/3 of the economy that contributes to GDP. And when you look at the consumer, the health of the consumer based on unemployment rates and their balance sheets actually looks quite good right now. So when you think about times like right now, the price of admission for investing can feel very scary with all the uncertainty that goes on. But when you consider the long-term market returns combined with market fundamentals that look good right now, we feel like the price is worth paying.